Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. Josh Knoll here, and only Josh Knoll here. I am flying solo today. I don't want you all to worry, though. Just buckle up and hang tight because we've got this. I'm going to try to do like old Rush Limbaugh used to do and give you a great show with half my brains tied behind my back. Michelle is off this week. Everyone else, our typical co-hosts, were a little bit busy. So here I am, flying solo once again, back in Coastal College's recording studio, beautiful downtown Fairhope, hoping to put on another great show for those of you tuning in today. Listeners, I'm here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. And for those of you listening that are looking for basically some straight conversation about how my industry, financial services, works, I think you found your show. In fact, I would say that we are often provide a contrarian view on some of the propaganda that's out there. So if you're new to the show, or maybe you've only listened a handful of times, I think it's worth your while to dive in. We've got a unique perspective and no filter. Here's what we got in store for you today. First segment, we're going to go deep dive on our topic of the day. Second segment, roughly 30 minutes past the hour, that is headlines of the week. And then about 50-ish minutes past the hour, stick around for our third and final segment. We call it Joshua's Crystal Ball and Big Mouth. So buckle up. We've got a lot to get to. Quick background on me. Again, for those of you new to the show, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website. It's gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you dismiss that, do not worry. Grab a pen, grab a pad. We're going to repeat it several times, our contact info several times throughout the show. Also, another kind of quick public announcement before we get to our main topic. Now, regular listeners will recognize the names of our frequent show co-hosts. Obviously, we'll start with the main co-host, the true co-host, and what I would call the breakout star of Coasting Retirement of this show. That's Michelle Melton-Knoll. But there's also regular contributors. There's Jay Stubbs of Providence Partners. There's J.D. Gardner and John Luke Tyner of Aptus Capital Advisors. There's even been an appearance and will be future appearances by my son and show producer, Peyton Knoll. So the announcement is, on top of featuring these incredible guests even more over the next handful of months, we are going to be expanding our guest expert pool. So stay tuned. We'll have tax experts. We'll have estate planning experts. We're going to have real estate experts, you name it. So those of you that are in or near retirement tuning in, that have a wide range of questions around money and investing, I position, as similar with my business, Gulf Coast Financial Advisors, I've got the best network to supply the answers. Very excited about our guest list for the rest of the year. Plus, I'm making a pledge to our audience to avoid reruns as much as possible. That happened some this summer. We got busy and we traveled, as regular listeners know. All right, so on to our main topic. What I want to do today is I want to kick off the show with a little history lesson. First, I'll ask a question. I can't hear your answer, but I'm just going to ask a question to the audience. Do we have any Prince fans out there? Maybe, maybe not. Is Coasting Retirement audience more of a Tom Petty audience, maybe? Which, no criticism, that's fine. Michelle loves Tom Petty. Michelle also loves Fish, not Phish, which she's quite the Fish fan. She's so much of a fan, she got me listening to him. But I bring up Prince specifically because one of his biggest hits is a song called 1999, which most of you would recognize more from the chorus of Let's Party Like, I'm not going to try to sing like Prince, Let's Party Like It's 1999. What most people forget, or at least I did, is that Prince released that song way back in 1982, well before 1999. which is kind of funny. The song was written, it was intended to be kind of a little bit of to mock a prediction made by Nostradamus that the world was going to end in 1999. I don't remember that prediction, but that sounds on cue, on par for what Nostradamus would say. I guess I'll give the listeners a hint. Nostradamus' crystal ball and big mouth was a little off on that prediction. But the point of this, for those of you investors that remember 1999, the actual year, not the song, but the actual year, the stock market took Prince's advice literally and partied like almost no other time in stock market history. The biggest driver of this party the stock market party in 1999 was the NASDAQ Composite Index. It's one of the major indexes that we discuss on this show, along with the S&P 500 and the Dow Jones and some other ones. In 1999, the NASDAQ Composite Index gained a whopping 85.6%. 85.6%, that's almost double. The other major indexes did fine as well. The aforementioned S&P 500, it gained 19.5% in 1999, and the Dow Jones was up about 25%. These gains, for those of y'all that don't know or maybe weren't alive then, these gains were primarily driven by the dot-com bubble and probably the highest demand at that point by investors for tech stocks. There was, in fact, there was ravenous demand from investors for these tech stocks, which included semiconductors, software, telecommunications, literally anything even somewhat loosely affiliated with the internet, which was still fairly new in 1999. That's what all fueled the market's rise. The performance was extraordinary. Some NASDAQ stocks gained thousands of percentage points in gain. Let me give you one startling example. And I tried to find a company that was still around today because, as everyone knows, or many people know, a lot of the .com companies are gone. Pets.com, anyone. But at the beginning, here's a company that's still around, Qualcomm. At the beginning of 1999, Qualcomm's closing stock price was $2.57 per share. The stock closed the end of 1999 at $55.13. For you math nerds, that's a 2,619% increase. Or maybe a more practical application, if you had bought 10,000 shares of Qualcomm at the beginning of 1999, and that would have cost you around $25,000 and change, you could have sold those same shares for $550,000 at the end of 1999, just less than 12 months later. I mean, to have a time machine, back in time, man, good grief. But fast forward to today. The reason I bring this all up, there are many commentators, and I know y'all have heard them, and many market analysts claiming that we are in the middle of yet another stock market bubble, this one fueled by sky-high market valuations of tech companies. Here's that tech again. But this time, those tech companies are heavily investing in artificial intelligence, or AI. There's a common saying that history doesn't repeat itself, but it does rhyme. So including today's episode, over the next couple weeks, we're going to do a deep dive on the current state of the stock market and investigate if investors should be worried about a market crash similar to the dot-com crash of 25 years ago. Are we partying like it's 1999 here in 2025? Today, I'm going to set up this discussion by giving you the similarities and the differences between the stock market in 1999 versus 2025. The next episode that I've kind of hinted at, that's going to feature John Luke Tyner of Aptus Capital Advisors. He's been on the show a handful of times, where we're going to not only discuss if the market is in bubble territory, like it was in late 1999, but hold on to your hat. John Luke and I have agreed that we're going to discuss if stock market bubbles even matter anymore. You heard me correctly. So this is heavy stuff, and I can't wait. But I don't want to get too far ahead of ourselves. We got to tackle what we're talking about today. In retrospect of 1999, probably the most famous quote around that time period, among multiple quotes, everything in hindsight is much 2020. Hindsight's 2020, is from former Fed Chairman Alan Greenspan when he coined the term irrational exuberance. Now, the funny thing is, in my opinion, I've got, as regular listeners know, I have an economics degree from what I teasingly call the Harvard of the Midwest, Missouri State University in Southwest Missouri. But as being in, when you're in economics as a degree, as with many degrees, but especially in economics, we were a little bit of a strange lot. You're combining language with math, so it takes kind of a unique perspective on studying and learning. But with that unique perspective, we were very tuned into what was going on with the economy, and I paid abnormal attention to Greenspan during that time period, because that would have been right when I was in college, and then shortly thereafter he served for a long time. But it's one of those things where, if you ask me, I think he is as guilty as any of them of keeping rates too low for too long and letting this thing kind of run out of control. Not the stock market is not his necessarily the Fed's responsibility. The Fed's responsibility is inflation and the job market. But it obviously had, as everyone has learned through recent conversation, what's going on between Trump and Jerome Powell, it definitely has an impact on the stock market. Now, for you younger listeners, it's probably hard to imagine a world without the internet, but in that time period, the dot-com bust was basically a culmination of a multi-year bull market fueled by the rise of the internet. Many of our listeners are old enough like me to remember I had to take classes in college on how to use the internet, which Michelle and I think we called it the World Wide Web even back then, which is hilarious. My introduction in college means that if you reverse back to high school, yes, my high school had basic computers, but I learned how to type on a typewriter. And I guess I'd ask you all, when's the last time you saw a typewriter? It's been a minute. So the question from this is, are we in an era of irrational exuberance again? So let's walk down memory lane here again. In 1999, investors poured money into unproven internet startups with little to no revenue, driven by the belief that a massive paradigm shift was underway. That sounds kind of familiar, doesn't it? Many of these companies had exorbitant valuations based on potential future growth rather than current earnings. That also sounds a little familiar. So for context, I had just graduated college in 1998. So in 1999, when this dot-com boom and coming bubble was going on, I had very little money to invest in the stock market. I did invest a little bit. I actually totally lost. I lost all of it because I invested in penny stocks based on dumb advice from a friend of mine named Paul. One of the seeds that was planted years ago that grew into the oak tree that led to this Coaching Retirement Show. But I do distinctly remember back then how the term day trader was a badge of honor and something that someone would say in immense pride, sometimes arrogance, when asked what they did for a living. I played basketball at a gym in a fairly affluent area, and I swear at one time I think that a third of the people there called themselves day traders. I can tell you all that if 1999 and 2025 have anything in common, outside of the market, which we're going to dive in a little more, it is the arrogance and condescending tone that the day traders used with me back in 1999 and the crypto bro uses with me now. There's a lot of similarities there. Talk on that later, on maybe subject for another time. But for now, let's look at the specifics in 1999. Economics. The U.S. economy was strong. A lot of people forget, but because of the scandal that President Clinton had towards the end of his second term with Monica Lewinsky, they forget that economically, he, by most measures, was a pretty successful president, which was surprising, generally speaking, because when he came into office in 1992, I don't think anybody was really thinking he was going to concentrate on the economy and balancing the budget. In fact, the last time the federal budget was balanced was under Clinton. Alan Greenspan had kept rates low. There was concern about the economy overheating, and there was a concern about the need to maybe raise rates, which, if you look back in time, he probably didn't do quick enough. The stock market, as we mentioned earlier, the performance was spectacular. I mean, we're talking, again, with the NASDAQ, which is where most of the tech stocks were listed, you had an annual return of 85.6%. I mean, just think about that, just easy numbers. If you had a portfolio of $1 million and you did nothing more in the beginning of 1999 but invest in a NASDAQ composite fund, you would have made over $850,000 in 1999 alone. Now, the question would have been, would you have sold out in time, or would greed have got you? Would fear of moving, better to be better to leave a day early and stay a day late, know when to fold them, Kenny Rogers, right? Most people didn't. And so the market being so concentrated in technology, especially in all these unproven .com companies. It was, again, in retrospect, it's kind of amazing that it even lasted as long as it did. But the .com guys were telling us that they were going to change the world. And to be fair, they did. It's just not as quickly as they thought. So one of the questions that I'm going to pose to John Luke Tyner is one of the big similarities between that era, 1999, .com, and our era, 2025, artificial intelligence, is that we are in the middle of technology change that is going to take longer than everybody wants it to take. At least the early adopters. It's going to be fun. It's going to be interesting to see how it plays out. Now, let's pivot to the stock market of 2025. It has also been defined by technology. This time, as we mentioned, it's centered around artificial intelligence, which is funny because it's on the lips of almost every investor now. But it hasn't been that many years ago that ChatGPT came on, that kind of exploded on the scene with their AI. So it's interesting how quickly that has come into dominance. Let's look at market performance year to date for 2025, so we can kind of compare and contrast for 1999. Year to date, S&P is up approximately 10 to 11%. I couldn't get a final number because it depends on how you measure it. So let's just say 10 to 11%. Well, that's obviously quite a bit less than it was in 1999. The NASDAQ has year to date performance of a little bit under 12%. That's obviously not 85%. And then the Dow Jones, which is a collection of 30 companies, much smaller tracking of index, it is up approximately 6.75%. Historically, the Dow Jones tends to be a little bit more industrial manufacturing related, which was something that could keep pace with the rest of the economy as far as the stock market valuations up until, say, the last 15, 20 years when technology has just blown all the other companies away. These are solid numbers, but they are significantly below the 1999 gains. Why? Well, one thing to remember is this: if you took out a handful of companies in 2025, most of them are going to be around the Magnificent Seven, which I'm going to detail a little bit more here in a minute. But if you took out most of the technology company or the main technology companies, and you took out this AI boom, the market itself, if you stripped away those two things, the large tech companies, which tend to be hand in hand with the AI companies, the rest of the market's not done that great. So it's kind of interesting to see that whereas in 1999, you had a small number of companies that had just such an outsized impact on the overall valuation and percentage increase of the market. Now you've got these behemoths, but there's just less of them. So it's interesting to see how that plays out. And it's something we're going to talk out through this episode in the next episode. The other thing that's different from 1999, the economic backdrop, I think it's fair to say, is more complex. We've always had, obviously 1999, it wasn't very long thereafter that we had 9/11 in 2001, which is terrible. So there's always been geopolitical risks, but we've got geopolitical risks going on across the world. We've got we also got the tariffs and the trade policy that's being changed pretty dramatically for the first time in many decades. We've had recent high inflation. That's something that America went many years without dealing with, and there is obviously a potential for a slowdown. And as you all know, people have been calling for a slowdown and or a recession now for months, if not years, on this. But the market continues on with strong returns. Probably the biggest difference, if you were an investor back in 1999, this will kind of ring a bell. Or really, honestly, if you're an investor anytime before COVID in 2021, is that right? 2020? Excuse me, 2020. The market always had volatility, but nothing like this. Since 2020, the volatility, which is a fancy way of saying how much does the market go up versus how much does it go down in a short period of time, has been all time. It's been amazing. And not only, we've had market corrections in the past. One of the biggest ones recently was COVID that I mentioned, but the market recovered in such a relatively short period that if you look at it on a graph, it basically looks like the stock market performance just did a high dive, got out of the pool, and jumped right back up on the high dive board. It's kind of crazy how fast it came back. The biggest part the thing that's been driving the market performance, and not just this year, but really for the last several years, is what's called the Big Seven. That would be Apple, Microsoft, NVIDIA, Alphabet, which is Google, Meta, which is Facebook, and then Tesla, which I don't think Tesla really belongs with those other ones, but that's conversation for another day. These companies, as opposed to the dot-com companies from 1999, all of these are profitable, cash rich, again, maybe with the exception of Tesla, and they have established business moats. So that's what you get where I'm going. Like, I think Tesla kind of falls outside of that. Apple, Microsoft, NVIDIA, Google, they have strong business moats around, barriers to entry into their market. So when it comes down to it, the basic question we're trying to answer over these next couple of episodes is, are we partying like it's 1999? Are we in another bubble? Do I think we're in an AI bubble? And I'm going to tell you that the short answer is yes. I would argue that our capitalistic system and how the stock market is constructed, in my opinion, it means we are often going from one bubble to the next anyway. It just happens to be this time is AI, which I would argue is better than having a crypto bubble, but that may come later. But as opposed to 1999, I think this bubble possibly has the staying power to last through the end of the decade. Why do I say that? Because, as we outlined just a minute ago, these are huge, huge companies investing billions and billions of dollars into AI technology, data centers, infrastructure, things like that. That was not, yes, there was a lot of infrastructure investment. I mean, if anybody was ever invested in the broadband rollout back in the late 90s and early 2000s knows that historically, when people do a rush like that, it's almost like the railroad system of the late 1800s. They tend to overbuild, and the first guy goes broke, and it's the second guy or third guy that comes in and makes money. So in this particular case, we've got hugely profitable companies with borderline monopolies in the particular industries investing billions of dollars. That's one thing. And everything I'm telling you all, I'm not saying that I can predict this, but we're talking about, do we think there's a bubble right now? Or are bubbles forming or is formed? Again, I say yes. And the other thing I think is on a macro level, I think that, and for regular listeners, this is a central tenet to the show and to how my company, Gulf Coast Financial Advisors, invests our clients' money. The overall stock market performance, this is important. You may want to write this down. The overall stock market performance is more closely tied to money supply and monetary policy than most people realize. Say it again. The overall stock market performance is more closely tied to money supply and monetary policy than most people realize. As our federal government has run budget deficits consistently over the past 6 decades, yes, over 60 years, there's just way, way more money in our system now versus 1999. You want some hard proof? So it's called M2 money supply. I don't want to get too nerdy here, but that's basically cash equivalents, things, money in the system. In January 1999, the money supply, United States money supply, was $4.4 trillion. In July of 2025, the money supply was $22.1 trillion, over 4 times larger. What does this mean? It means, simply put, there's way more money, and money is like water. It wants to flow somewhere. You can directly correlate the increase in money supply to the dramatic increase in the major stock market indexes over the past 50 to 60 years. If you all want to learn the history of those market indexes, look in our back catalog and go find the episode where we talk about past the market indexes over the last 50 years. It's fascinating. But does that mean that there won't be a bubble crash sooner than I think? Of course not. All investing involves risk, and while it's highly improbable that the U.S. stock market would, quote unquote, lose everything, like some people will say, well, I'm all in stocks, I could lose everything. Technically, that's true, but typically that doesn't happen, especially across a huge section of the stock market. It does mean that, there could be a severe correction that can be devastating to investors. But what if the market does correct like it did in 1999? What if it does? Right? Have you all ever asked yourself that when you're seeing you're doom scrolling, or you're seeing the commercials where they're telling you that the market is just going to completely crash out and you need to put all your money in gold? What if it does? I'm going to melt your all's brain just a little bit. I'm not sure that it matters if the market crashes like 1999, not in the long run. I'm not sure that bubbles matter that much anymore in the short run. That sounds a little heretical coming from a financial advisor, but there is so much money in circulation today. And America is still the safest place to put it. So two statements I just make there, I want you all to know, don't stamp that in concrete just yet, because we're going to be hashing this out with what I consider an industry expert in John Luke Tyner of Aptus Capital Investors next week around this. Are we in a bubble? If we are, it doesn't matter. I hope you all come back and tune in. Listeners, if you like what you've heard so far and you want to set up a follow-up conversation with the team at Gulf Coast Financial Advisors, it's very easy. You can call us at 251-327 or 251-327-2124. Need those last 4 digits. Or find us on our website, gulfcoastfa.com. FA stands for financialadvisor.com. On our site, click on the blue button that's in the upper right-hand corner. That will put a meeting on my calendar. There's flexible choices for your meeting for convenience. It can be as simple as a 15-minute introductory phone call. It could be a 30-minute Zoom, or my preference, it can be an in-person meeting, any of our 3 office locations. Again, we're located in downtown Fairhope. We got an office in Orange Beach, just down the road from the wharf off Canal Street, or Canal Road. And we're also in Mobile, near the intersection of Dolphin Street and I-65. However you reach out to us, please do. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we give you our honest opinion about these headlines. So I want you to join us after the break to hear me discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Knoll, here. So, as I discussed before the break, every week we scour what Michelle calls the interwebs for financial articles that pertain to those of you in or near retirement, or really just investors in general. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we include the article links in our show transcript, which you can find on the website, gulfcoastfa.com. Just go into the podcast tab, look for Coasting Retirement, find the episode you want to listen to, and look for the transcript. There will be the links. But without further ado, let's get at it with Headlines of the Week. Now, the first article that I pulled, it's from a news site. I'm taking it on a little bit of a test drive. We'll see. It's called Mint Markets. If any of you all, side note, if any of you out there listening are voluminous news readers like I am, then you know it's getting harder and harder to find non-paywalled sites. So, as much as I'd love to reference the Wall Street Journal or even Bloomberg or something like that, they're just paywalled. And so those links, you would just go and it'd be frustrating. Mint Market appears to be paywall free, at least so far anyway. Their fresh off the press article is titled U.S. Stock Market Valuations at Historic Highs Seen Before Great Depression, .com Crash. It's not great English on this title, folks. Is a major correction coming. So basically, it's saying that stock market valuations are at highs that we haven't seen since the Great Depression. That's a better way to title that. This article follows along with the basic discussion we had in our show opening, but it does take us on a Nerdville turn with some stats, which I love. It references the Shiller PE ratio, which you got to be an economics/investing nerd to even know what that is. But the Shiller PE ratio it's a metric used to assess whether a stock market, or even you can do it on individual stock, is over or undervalued based on its long-term earnings. It's just one of the many tools you can look for evaluating stocks. The the Shiller PE ratio has been hovering around, I guess, around 37 to 38. I'll be honest with you, I don't pay any attention to it. If we pay any attention to anything, we pay attention to the VIX and the major indexes. But it's apparently been hovering around 37 or 38 in 2025, which I'm assuming that's high. For context or contrast, right before the dot-com bubble burst in 1999, the index was 44. So what does all this gobbledygook mean? It means that by some measures, we are running at a overvalued stock market similar to what we experienced right before the dot-com crash. That's concerning, right? So in this article, it lists kind of, again, it goes to Nerdville a little bit, but for you sophisticated investors, I think it's a good article for you. It goes into, kind of some things. What should investors do? It talks about equities. Now, remember, again, not to insult the intelligence of our audience. Most of you already know this, but bear with me. Equity is kind of a general way of saying stock. Now, it means more than just that, but just in our line of work, it means stock in a company. So if you want to hold equity in, let's say, Apple, then you would buy an Apple stock. Okay, you would have equity in Apple. You'd own an Apple stock. If you wanted to lend Apple money, you would buy an Apple bond in exchange for a certain amount of interest paid on that bond. The stock that you buy in Apple, you're hoping for not only capital appreciation in the form of the stock going up in price, but you're hoping that if Apple makes a profit, they distribute some of that profit through the form of dividends in there so that you get a kind of a double whammy of potential gains with that individual stock. On the flip side of that, on the bond side, you're typically only going in that looking for the yield, again, fancy way to say interest that it pays. And sometimes you'll have bonds that increase in value. Why does a bond increase in value? Because interest rates are getting lowered in the current term. That means that the bond that's paying higher interest than what you can buy a new bond for demands a little bit of a premium. Consequently, all you bondholders know this from 2022, when interest rates are risen quickly, your bond prices go down significantly. In fact, 2022 was the worst bond performance literally in history of the U.S. bond market, if you can believe that. It was bad because we have never risen rates that fast, and it caused the bond market prices to crash. Now, back to this, I think it's important that you when you're investing right now, you're doing it with eyes wide open, right? You know that this is not like we're emerging from, let's say 2000 after the dot-com crash, let's say 2008 when we had the construction, mortgage-related housing market crash, something I experienced firsthand. And that market took a while. It's not like there's discounts and deals laying around for you to buy right now. There are things that you can be smart about when you're looking at buying. And one of the things that we argue is at Gulf Coast Financial Advisors is that the opportunity cost of being too skittish on some of this stuff is not worth it, especially on your long-term money. Now, if we're talking short-term money, where something needs to be in place where you need to make a large purchase like a house or a car, or where some amount of money that we're dedicating towards income production, maybe we're even throwing in an income annuity, that's a different conversation. But for those of y'all, especially if you're only in your 60s, for those of y'all that potentially have another 20, 30, maybe 40 plus years, you want to be very careful, and we're going to talk more about this in this episode. You want to be very careful about shying away just because some talking head on TV is telling you that the market is radically overvalued. More often than not, at any moment, the market is overvalued because it prices in its future expectations. Okay, understand that? But over time, if you look back, and again, we did a show on this, if you look back, the market is, again, as long as you believe in the future of the United States and the stock market, the market tends to move up and to the right over time. Doesn't mean that the corrections and the dips and the sell-offs are not painful, but if your money is long-term, it should be built to withstand that and hold on and take advantage of those moments, which we'll talk about more here in a minute. All right, moving on to our second article. It is from Yahoo Finance. It's titled, now Michelle's not here, so I decided I could have some Nerdville ones here. This Yahoo Finance article is titled, "What is the 10-year Treasury note and how does it affect your finances?" So as we discussed in the show opening, most investors are not aware that how much impact the money supply has on the performance of their investments. It doesn't mean that if the United States government keeps printing money to service its debt, that the stock market's going to go up in eternity. That's not what I'm saying. What I'm saying is when you devalue money and print more of it, money tends to find risk assets, which by definition are stocks. Stocks are considered risk assets. And people flood to risk assets because they want to stay ahead of inflation. Inflation is when your dollar buys less than it did a day ago, a week ago, a year ago, 10 years ago. And that's what happens when you print more money. I would also argue along that same line that people don't understand the importance of the 10-year Treasury on a lot of things. For example, it doesn't directly set mortgage rates, but it's heavily influences. Plus, it's a barometer of what investors are projecting in the future. For those of y'all that are news junkies like me, if you recall back when we had Liberation Day, when President Trump announced all those tariffs, for those of y'all that pay attention to the bond market freaked out. And it basically, if I remember correctly, the yield or the interest rate started jumping up significantly, which I believe was an indication that the investment community at large felt like extreme inflation was coming our way and coming our way quickly. What has been interesting about the 10-year Treasury, there's a couple things that have been interesting about the 10-year Treasury. One is, as with everything, there's been a lot of volatility. Not that the 10-year Treasury necessarily was just like a flat line, smooth, anything like that. It's going to jump around because it's forecasting to some degree 10 years out. But it's had extreme volatility. And I mentioned mortgage rates earlier. I don't know where the spread is between mortgage rates and the 10-year Treasury are right now. I just know that this year that there was time periods where the spread, what I mean by that, the margin of separation, where the 10-year Treasury yield or interest rate it paid was over 2 percentage points lower than what you could get on a 30-year mortgage. That's unusual. Usually they kind of stay in lockstep and they stay in that 1-ish range of each other, less than 2 anyway. But that definitely jumped up, and we saw some of that last year, 2024 as well. So that's interesting. So the point of that is, when you're banging on Jerome Powell, Fed Chairman Jerome Powell, to lower interest rates in order to get lower mortgage rates, that's not the full picture, because the 10-year Treasury, it's obviously going to be influenced by what the Fed does. There's no doubt. Everything's influenced by what the Fed does. But it also is going to operate somewhat independently in telling you if it thinks that what's going to happen over the next handful of years. For example, if yields go up on the 10-year Treasury, then what we're looking at is they're saying that potentially there's inflation, right? If the yield on 10-year Treasury goes down, that's considered generally a indication that investors, again, at large, investors think that the economy is going to need some help, that unemployment may be bad, and that we may have to lower interest rates in order to stimulate hiring and consumer demand. You see how that works? So it's interesting. What we've seen is this 10-year Treasury just kind of being a yo-yo. And part of that is because, it's been beyond my lifetime before tariffs were this heavily discussed, and tariffs have an outsized impact on long-term inflation. So it's interesting to see how that plays out. It's one of the things that you definitely want to pay attention to. I know it seems a little bit kind of, again, nerdy, but to consider money supply and the 10-year Treasury. But these things have outsized importance on your investment portfolio, things that we pay attention to. All right. Next article, our third article, maybe the last one we get to. We'll see how much time I got here. I'm going to pivot to Morningstar. They've got an article titled, "Have the Magnificent Seven Left Active Large Cap Funds in the Dust for Good?" All right, so there's some industry jargon there. First, let's talk about the Magnificent Seven. Who are they? So that is Alphabet, which is Google. That's Amazon, Apple, Meta, which is Facebook, Microsoft, NVIDIA, which is chip designer. They don't necessarily manufacture their own chips. And then Tesla, again, which I argue I'm not 100% sure Tesla belongs there. I guess we'll see what happens with their automated driving and AI and all that. On the other side of this, explaining that the newspaper article or headline, what is an active large cap mutual fund? That is a mutual fund that invests in the stocks of large, well-established companies, usually, high market capitalization. That's a fancy way of saying these companies are worth many, many, many billions of dollars. And typically it's managed by a professional fund manager or managers. They're trying to actively, that's the active part of it, select stocks with the goal of outperforming a market benchmark index. The fund manager researches, they pick the individual securities, they change their portfolio based on market conditions. The overall goal that they have is they're trying to generate a higher return than passive funds. And guess what? They haven't done it, at least not consistently. In this article, it tells you, I don't want to thumb through this whole thing, but it's over the last 20, 25 years, it's a rare occurrence for an actively managed mutual fund, which tend to be kind of expensive on expense ratio, to beat generally speaking, more affordable or lower expense ratio passive index fund. The passive refers to, hey, we're gonna mimic probably the most famous index fund would be an S&P 500 index fund. Now, of course, you can have an S&P 500 index mutual fund, and you can have an S&P 500 index ETF. We use ETFs in individual stocks. But the point to make here is, so at Gulf Coast Financial Advisors, in our work that we do with Aptus Capital Advisors, we're going to be focused on exchange-traded funds, ETFs. We don't do mutual funds. Especially those of y'all familiar with the industry, we don't do any commission-based type of securities work. That would be either on individual stocks, with commissions, or most of y'all are familiar with Class A mutual funds, the historically like American Funds, Capital Group. A lot of times those were Class A. They paid the broker that sold them to you, they paid them a commission up front, usually somewhere in the 5% range. So if you gave your broker $100 to put into American Fund mutual fund, the $95 would go into the fund, $5 would go to the American funds, and then your broker would get some kind of split of that $5. We don't do any of that. We manage on a fee-for-service basis, assets under management, it's a technical term, and we're going to be using ETFs and stocks exclusively. Now, why is that important? Because there is, with those Magnificent Seven, a couple things have really happened that's kind of interesting. One, that because these companies have gotten so large and so valuable, they make up a disproportionate amount of the overall index valuation. Again, I don't have this in front of me, but NVIDIA itself, if I recall correctly, is somewhere in the neighborhood of 7%, somewhere in that range of the total valuation of the entire S&P 500 index, which the 500 should tell you something. That's 500 companies selected by Standard & Poor to be part of their index, right? It's supposed to be the best of the best. But even with being the best of the best, NVIDIA, because it's worth, $4 trillion or something like that now, is a significant chunk of that. So if you're an active mutual fund manager and you're sitting there thinking, well, I want to beat the index guys, the average guys, so I can't do that by basically running the same horse race. I can't be putting 7% of my clients' money in NVIDIA, because then I'm going to be no better than index fund. I'm going to try to historically go after mid cap and low cap funds, and I'm going to try to beat these index funds. Well, guess what? It hasn't happened, because not only are the expense ratios cheaper, generally speaking, with ETFs, so more of your dollars go to work than they do typically in mutual funds. Not always. Vanguard's got some very low cost mutual funds, but also, as I said earlier in the show, the majority of the gains have been had by these Magnificent Seven. So it's kind of a catch-22, a chicken or an egg conversation. If you are looking at investing, there's nothing wrong with being contrarian. And again, there's an argument to be made that some of these companies that are heavily invested in artificial intelligence are going to be just like the railroad companies of yesteryear, where they're going to overbuild capacity, and it's going to really ding them and hurt them badly, and it'll be the second or third guy that makes money. But for now, if you're wanting to have adequate returns that beat inflation, keep up with the market, hopefully beat the market, you're going to have to own the risk assets. And if you're going to own the risk assets, then you got to be looking at individual stocks, and you got to be looking at some of the stocks, whether you like it or not, that are producing most of the gains over this time period. You don't know when the bubble's going to be. No one does. There's a segment of the show called My Crystal Ball to make fun of the fact that I don't have one. So the main thing is you want to, all investing involves risk. Obviously that ride can be disconcerting. And, as we've said many times on the show, if anyone ever asks me if we got a stock market correction coming or a recession coming, my answer is always yes, because that's how our capital system works. But in the interim, instead of you trying to judge that time period and time the market, which is impossible, it's never been done, what you want to do is on your long-term investments, you want to hold risk assets so that you are not having your purchasing power destroyed on a daily basis. Got it? Good. All right. If you'd like to continue that conversation, dive a little deeper, especially around your own personal retirement dreams, your own investment accounts, I'm going to invite you to call us, 251-327-2124, or find us on the website, gulfcoastfa.com. On the site, there is a blue button in the upper right-hand corner that will put either a 15-minute introductory phone call on my calendar, or you can do a 30-minute Zoom, or my preference, let's meet. Let's see what each other looks like. In-person meeting, 3 office locations, downtown Fairhope, Orange Beach, and Mobile. Our folks coming up next, Joshua's Crystal Ball and Big Mouth. What have been some of my predictions? Have I been right? Was I ever wrong? How wrong? What do I think is going to affect investors in the near future, or maybe the distant future? We talk about all these things to poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here, all by my lonesome self today in studio. For this segment, I am opinionated. I do have strong opinions at times. I would say a radio show host that isn't opinionated would probably be very boring to listen to. So hopefully we haven't bored you this last 45 minutes. I am paid in my profession, financial advisor, offer professional guidance and opinions to my clients. Otherwise, this replaces me with AI. And while I like to make predictions, I feel like because I'm kind of skeptical of my own industry that a lot of times I'm right. There are times I swing and miss. So let's get at it with Joshua's Crystal Ball and Big Mouth. So here's this. We're going to take a big swing on this one. Here's what I think. We touched on this a little bit in the opening. For folks that are concerned that this is prediction time. I'll save my eating crow on a bad prediction when Michelle's back, or who knows, maybe this prediction tends to be all wrong as well. I do get so we've been talking about artificial intelligence and a bubble in the stock market, and I think that there's 2 kind of broad things that has done. One, there's a lot of you all that are scared of getting into the market right now because it is very high, and that's fair. I get it. 2, and this isn't your fault, but 2, there's a significant chunk of my industry that is geared, designed, trained killer assassins on this is their time to stoke a lot of fear around the stock market in order to sell you a product, typically speaking, an insurance product. There are a place for some of these things that, kind of for those of y'all that don't like the roller coaster ride, that want to kind of carve out some of your investment dollars and keep them a little bit more contained, knock the volatility down, maybe to protect the downside risk, and you're okay losing some of the upside potential. But it cannot be the majority of your assets, because I think right now, the underlying, back to the bubble conversation, just like with the dot-com boom, there was an underlying use case there around these companies getting the internet going. I mean, good grief, just look at Amazon. And compared to today, as much as I am concerned and a little wary, and I've been trying to use artificial intelligence so that I'm not just totally caught flat-footed. But it's obvious that there's going to be multiple use cases for artificial intelligence. I mean, selfishly, I wouldn't mind if call centers used it so that when I called in, I didn't wait on hold. And even if it is a machine, if it's a machine that can speak to me in a manner which I can understand, and I only have to hold for a little bit, and it can get the answer, let's say 95% of the time, I'll take that versus being on hold for 30 minutes or longer and talking to somebody that I don't understand. It drives me nuts. When you call in to some of these companies, they say, we're experiencing longer than expected hold times. My initial reaction, one, I want to throw the phone against the wall, but two, I'm like, then you should have hired more people, because I'm hearing this every time I call into your call line. It's nonsense. Anyway, back to what it means to the bubble. I do think we are in a little bit of a bubble because there's so much money sloshing around, but the difference between now and the .com is I think that there is the strength of the companies that are producing some of the bubble and the volume of money that's going into it. And most importantly, there is a use case for artificial intelligence. Okay. So my prediction is, yes, you're going to see around AI, you're going to see a little bit of a cleaning out here probably in the next couple of years. I would say by the end of the decade, you will see a cleaning out of that to some degree. Well, I hope that was enjoyable. I hope you all like seeing how we form the opinions around the basis of the show, get a little peek behind the curtain. We invite you one last time, if you would like to have a no pressure, no obligation conversation about your investments and your retirement dreams, give us a call, 251-327-2124. Website, GulfCoastFA.com. FA is a financial advisor.com. Blue button, upper right-hand corner. That can be phone call, Zoom, in-person meeting. Let's meet in person. Downtown Fairhope, Orange Beach, or Mobile. However you want to do it, we'd love to meet you. Folks, that is it for this week. I want to give a huge thank you to, I can't say thank you to my co-host. I do miss her, though, Michelle Lee Melton-Null. For those of you all curious, the -Null, Michelle and I are married. I don't think it's a great secret. We've been married about 1.5 years. Took her a little bit to get in Social Security, though, to get that last name added, but it finally is added. Thank you to our show sponsor, that's J Stubb, Mr. J Stubbs and Providence Partners. Thank you to our radio stations, that's FM Talk 106.5 out of Mobile and WHEP 92.5 FM out of Foley. Many thanks to the provider of our show music, that is local band Sloth Racer. Huge thank you to the show producer, that's my son, Peyton Knoll. Can't wait to see him this weekend. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be part of your journey as well. Remember, till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.